Right now, thousands of Australians are about to miss a perfectly legal super tax deduction, and most of them don't even know it exists. The financial year ends the 30th of June. That deadline is not flexible, it does not move, and once it passes, this opportunity is gone for another 12 months. If you've been working hard, saving money, and still feel like you're not getting ahead, this video is for you. Here's the thing. Most Australians do the right thing. They go to work, they pay their tax, their employer puts money into their super every fortnight, and they think that's enough. But the tax system has rules that actually work in your favor, if you know how to use them. The problem is most people never find out about these rules until it's too late. They see their tax return in July or August and think, could I have done something differently? Often the answer is yes, and one of the most commonly missed opportunities is making a personal concessional contribution to your super before the 30th of June, and then claiming it as a tax deduction. So what does that actually mean? Let's break it down simply. Your super fund receives contributions in two basic categories. The first is concessional, meaning before tax contributions. These are taxed at just 15% inside your super fund. The second is non-concessional, after-tax contributions. No tax inside super because you've already paid tax on that money. Now, here's the part most people miss. If you make a personal contribution to your super from your own bank account, using money you've already paid income tax on, you may be able to claim that contribution as a tax deduction. This can effectively shift that money from being taxed at your personal income tax rate, which could be 32.5%, 37%, or even 45%, down to just 15% inside super. That difference is real money. And this is completely legal. It's built into the tax system. The catch? You have to act before the 30th of June. Let's use a simple example. Say you earn $85,000 a year. Your marginal tax rate is 32.5 cents in the dollar. You have $5,000 sitting in savings that you don't need access to right now. You decide to contribute that $5,000 into your super as a personal concessional contribution. You then lodge a notice of intent to claim a deduction. More on that in a moment. Inside your super fund, that $5,000 is taxed at 15%. That's $750 in contributions tax. But on your personal tax return, you've reduced your taxable income by $5,000. At 32.5%, that's a $1,625 tax saving. So the rough net benefit? Around $875 compared to leaving that money in your bank account and paying full income tax. Those numbers are illustrative only. Your situation will be different, but it gives you a sense of how this can work. Stay with me, because the next point is the most important one of all. Now, is this strategy right for everyone? No, but it may be worth a look if you fit one of these profiles. You're an employee who has some savings set aside that you won't need for years. You're self-employed or a contractor, and your super contributions have been inconsistent. You had a higher income year than usual, maybe a bonus, a capital gain, or extra work. You're in your 40s, 50s, or early 60s, and want to give your retirement balance a meaningful boost. Or, you haven't used your full concessional contribution cap in recent years, because there's a catch-up rule that may let you contribute more. If any of those sound like you, this strategy deserves your attention before the 30th of June. Here's where Australians often get caught. They hear about this strategy in late June. They decide to act. But they wait too long. Your super fund must actually receive the contribution before the 30th of June. Not sent, not processed, received. If you're transferring from a bank account, that can take 1 to 3 business days. If your super fund has a backlog of last-minute contributions, and they do every year, your money might not clear in time. So if you're thinking about this, the time to act is now, not the last week of June. Now, let's talk about the mistakes that trip people up, because this is where the benefit can completely fall apart. Mistake 1, waiting until June 29 or 30. Too risky. Processing delays can cost you the whole deduction. Give yourself at least a week. Mistake 2, exceeding the concessional contribution cap. For most Australians under 75, the annual concessional cap is currently $30,000. That includes your employer's compulsory contributions, salary sacrifice, and any personal deductible contributions. If you go over that cap, the excess gets taxed at your marginal rate, and the whole point of the exercise is defeated. Check your super account and your last payslip carefully before contributing. Mistake 3, and this one is critical, forgetting the notice of intent form. This is the step most people miss. Making a personal contribution to super does not automatically make it tax deductible. You must submit a notice of intent to claim a deduction to your super fund, and it must be accepted before you lodge your tax return. Without that form, no deduction. Simple as that. Mistake 4. Assuming salary sacrifice is the same thing. It's not. Salary sacrifice is arranged with your employer before you're paid. Personal deductible contributions come from your own savings after you've been paid. Different process. Don't confuse the two. Mistake 5. Not checking your eligibility. There are age rules, work test requirements for some age groups, and total super balance thresholds that can affect what you're allowed to contribute. Don't assume, check. Mistake 6. Putting in money you actually need. Super is locked away. You generally can't touch it until you meet a condition of release, usually reaching preservation age and retiring. If you need that money in the next few years for a house deposit, an emergency, or living costs, do not put it in super. And this one mistake can undo the whole benefit, financially and practically. Alright, let's make this actionable. Here is a simple 6-step checklist you can use right now. Step 1. Log into your super account and check how much has been contributed this financial year in the concessional category. Step 2. Check your concessional cap. Most people can contribute up to $30,000 total. Work out how much space you have left. Step 3. Check your cash flow. Only consider contributing money you genuinely won't need outside super for the foreseeable future. Step 4. Contact your super fund. Ask them about the process for making a personal contribution and confirm their cut-off date to receive funds before the 30th of June. Step 5. Once contributed, download and complete the notice of intent to claim a deduction form from your super fund. Submit it and get written acknowledgement. Step 6. Before you claim it on your tax return, speak with a registered tax agent or financial advisor, especially if your situation is complex. That's it. 6 steps, simple and straightforward. But here's the honest truth. This strategy is not magic. It's not going to transform your retirement overnight, and it's absolutely not for everyone. If you're on a lower income, the tax saving may be smaller, and the trade-off of locking money inside super may not be worth it. If you might need that cash within the next few years, don't do it. And if you're unsure about any step, please talk to a professional before acting. The ATO's website also has clear information on personal super contributions if you want to do your own research. The goal here is not to tell you what to do. The goal is to make sure you at least know this option exists before the deadline passes. So let's bring it all together. Most Australians pay more tax than they need to, not because of anything they've done wrong, but simply because they didn't know a better option was available. The personal concessional super contribution strategy is one of the most straightforward examples of a legal, well-established way to potentially reduce your tax bill and boost your retirement savings at the same time. But it only works if you act before the 30th of June. Check your cap, check your cash, contact your fund, lodge the notice of intent, talk to a professional. That's how you use the rules properly before the financial year closes. If this video helped you understand something that was never explained clearly before, that's exactly why this channel exists. Hit the like button if you found this useful. It genuinely helps more Australians find these videos. Subscribe to Simple Money Aussie with Rafiqi so you never miss a simple money rule explained in plain English. And drop the word super in the comments below if you want more videos like this, covering Australian superannuation, tax, and retirement strategies in simple, everyday language. See you in the next one.